Have you ever wondered how you can own a tiny piece of a massive company like Apple or Amazon just by tapping a few buttons on your phone? It all comes down to stocks and the stock market. A concept that feels so modern, but its roots go back centuries, long before computers or even electricity. Today, we're going on a journey through time to uncover the fascinating history of the stock market, from bustling Dutch canals to the concrete jungle of Wall Street. Our story begins in the early 1600s, in the vibrant city of Amsterdam. The world was in the midst of the age of discovery. European powers were sending ships across treacherous oceans to trade for exotic goods like spices, silks, and tea. These voyages were incredibly risky. A ship could be lost to a storm, pirates, or disease, and the entire investment would sink to the bottom of the sea. But if a ship returned safely, the profits were enormous. No single person, not even the wealthiest merchant, could afford to finance these voyages alone. The risk was just too high. So, they came up with a brilliant idea. What if they pooled their money together? This led to the birth of the world's first publicly traded company, the Dutch East India Company, or the VOC. The VOC was for the first time ever, it allowed regular citizens, not just the super rich, to invest in these trading expeditions. They did this by selling shares, which were literally pieces of paper representing a small ownership stake in the company. If the company's voyages were successful, the value of your share went up, and you received a portion of the profit, called a dividend. If the voyages failed, you only lost the money you initially invested. This created a brand new problem, or rather, an opportunity. What if you bought a share but needed your money back before the ships returned, which could take years? Or what if you missed the initial sale and wanted to buy in? This need gave rise to the world's first stock exchange, right there on a bridge in Amsterdam. People would gather to buy and sell these VOC shares from each other. The price wasn't fixed. It fluctuated based on supply and demand. If a rumor spread that a fleet was returning with a huge haul of cloves, the share price would shoot up. If news came of a shipwreck, the price would plummet. This was the birth of stock trading as we know it, complete with speculation, market bubbles, and dramatic crashes. It was a chaotic, exciting, and completely new way of thinking about money and ownership. As the idea of joint stock companies spread, other European cities followed Amsterdam's lead. London, in particular, became a major financial hub. In the late 17th century, merchants and brokers would meet in coffee houses, like Jonathan's Coffee House, to trade shares. It was informal, loud, and fueled by caffeine. These coffee houses became the precursors to the London Stock Exchange. But it was during this time that we saw one of history's most famous financial manias, the South Sea Bubble. The South Sea Company was granted a monopoly on trade with South America. Everyone, from aristocrats to maids, got caught up in the frenzy, borrowing money to buy shares, believing the price could only go up. The share price skyrocketed, but the company's actual business was almost non-existent. When the bubble inevitably burst in 1720, fortunes were wiped out overnight, and it served as a harsh lesson about the dangers of herd mentality and speculation without solid fundamentals. Now, let's cross the Atlantic to the newly formed United States. After the Revolutionary War, the young nation was in a lot of debt. To solve this, Treasury Secretary Alexander Hamilton proposed that the government issue bonds, essentially loans from citizens to the government, to create a market for these bonds and for the shares of new American companies. A group of 24 stockbrokers decided to get organized. On May 17, 1792, they met under a buttonwood tree on a street in New York City. That street was named Wall Street. They signed an agreement, fittingly called the Buttonwood Agreement, promising to trade only with each other and to charge a standard commission. This simple act laid the foundation for what would become the most famous financial market in the world, the New York Stock Exchange. The 19th century was a period of explosive growth for America, and the stock market was right at the center of it. The Industrial Revolution was in full swing. Railroads were crisscrossing the continent, factories were churning out goods, and innovations like the telegraph were connecting the country. All of this required massive amounts of capital, and the stock market was the engine that provided it. Companies like railroads, steel producers, and later, oil companies, raised money by selling shares to the public. This era also gave us legendary figures like Cornelius Vanderbilt, Jay Gould, and J.P. Morgan, the so-called robber barons, or captains of industry, depending on your perspective. They built immense fortunes by mastering the stock market, engaging in epic corporate battles, and sometimes manipulating prices for their own gain. The market was a wild, unregulated place, a true financial frontier. Then came the 20th century. The roaring 20s saw another massive stock market boom. The economy was soaring, and a new sense of optimism swept the nation. People believed they could get rich quick in the stock market. Taxi drivers were giving stock tips, and people were borrowing heavily to buy stocks on margin. The market became dangerously overvalued. This all came to a crashing halt on October 29, 1929, a day known as Black Tuesday. The market collapsed, triggering the Great Depression, the worst economic downturn in modern history. The crash was a brutal wake-up call. It led to sweeping financial reforms, including the creation of the Securities and Exchange Commission, or the SEC. In 1934, the SEC's mission was to protect investors and maintain fair and orderly markets, ending the Wild West era of finance. The post-war era saw the rise of the individual investor. Mutual funds made it easier for ordinary people to diversify their investments. Then, in the late 20th century, technology changed everything. The internet and personal computers democratized finance in a way that was previously unimaginable. Suddenly, you didn't need to call a broker to place a trade. You could do it yourself, from your home with just a few clicks. Online brokerage firms offered low-cost trading, and a wealth of information was available to anyone with an internet connection. This led to the dot-com bubble of the late 1990s, another classic tale of speculative frenzy, followed by a painful bust. And that brings us to today. From a handful of merchants on an Amsterdam bridge to a global network of interconnected computers, the stock market's journey has been incredible. It has fueled innovation, built industries, and created immense wealth. It has also been the source of devastating crashes and painful lessons. But at its core, the fundamental idea remains the same as it was 400 years ago. It's a powerful mechanism for people to come together, share risk, and invest in the future. What do you think the next chapter in the stock market's history will be? Let me know your thoughts in the comments below. Thanks so much for watching. And if you found this journey through financial history interesting, be sure to hit that like button and subscribe for more videos. See you next time.